Here at home, we are setting up for a big week of economic reports, including GDP and PCE, the Fed's preferred inflation gauge. Our next guest sees inflation slowing, and he still sees a cut in the cards this September. Joining us now, Brian Rose, senior U.S. economist at UBS Global Wealth Management. Also with us, CNBC senior economics reporter Steve Liesman. Let me begin with you, Steve. How have we gone from a forecast of 6 rate cuts, 6 at the beginning of the year, now down to maybe 1, maybe 2, maybe 0?
Tyler, would you mind if I corrected you for a moment?
Of course.
There wasn't actually at least a forecast from the Fed for 6 rate cuts. There was a pricing in futures markets for 6 rate cuts, which was double the Fed's forecast. So there's actually been 2 stages of this. One is the market coming down to where the Fed is, 6 to 3, and now a question of, is it 3, 2, 1, or 0? So we're sort of in that phase right now, and I think it's happened in a couple phases. The Fed ran, an open mouth operation to kind of bring the market down to where it was when it came to 3. And then the data started coming in a little difficult when it came to inflation. And this 3 months of slower progress on inflation has the Fed sort of backing off this idea of, it's likely appropriate to cut this year. We don't even hear that anymore. And we also don't hear these forecasts. For example, Goolsbee, speaking this morning, had earlier very openly talked about his forecast for 3 cuts from the March SEP. He doesn't talk about that anymore.
All right, let me turn to you, Brian, if I might. Where are you on the number and timing of interest rate cuts this year, if any? And I guess more poignantly, or maybe pointedly, what will it take for the Fed to decide that they are ready to cut interest rates? What data will they need to see, and for how long?
Well, our base case is that the first cut will be in September, and then we see another cut in December. Of course, this all depends on how the data actually comes in. And from the Fed's perspective, at the moment, the biggest problem is the inflation data. So after very good prints in the second half of last year, all 3 months of CPI data we had so far this year are too high, and those numbers will have to come down for the Fed to cut. But it's not all bad news for the Fed if you're looking to cut. One of the big things that I think doesn't get enough attention is that wage growth has slowed and continues on a downward trend. This makes it a lot easier for the Fed to cut because it has implications on the medium-term outlook for inflation, which is really what the Fed's concern is, right? They want to know, where's inflation going to be 2025, 2026? Are we heading towards the target? And the slower wage growth, helps them to reach the target over the medium term.
So, Chair Powell, go ahead, Steve, jump in.
Yeah, Brian, I wanted you to sort of solve a problem that I have. The first quarter PCE, we get it coming this Friday, an important number, but the Fed's already forecast it, and most forecasters probably have it right. Core PCE is going to come in at 2.8. The average for the quarter is going to be 2.8. The Fed forecasts 2.6% for the full year. We're 0.2 off of the forecast for the full year. When it forecasts 2.6, the average Fed official forecast 3 rate cuts. So Tyler and I were talking about this the other day about losing your kingdom for a horse. Would you give up all 75 basis points of rate cuts because you're running 0.2 hotter than you expected? Doesn't that seem extreme?
Yeah, this is a really good point, is that if you look at the Fed's forecast from back in March, they were looking for strong growth. And certainly their forecasts are above consensus.
Right.
As you said, the 2.6 for PCE inflation at the end of the year, and we're still willing to cut 3 times. So we're not miles away from what we need to see for the Fed to cut. I think the problem, though, is that especially if you just look at a chart of the monthly or CPI prints, it's not clear that it's actually slowing. If you look at a chart, it looks like, if anything, inflation is picking up, and that's a big problem. Also, the way that the March inflation data missed, which is a big increase in core services ex shelter, which is Powell's been talking about since 2022. So the way the inflation data missed was troubling. and the recent trend is troubling. So, I mean, you need the inflation data to improve, but as you're suggesting, not by a huge amount. I would say if we had 0.2s on core PCE going forward, that would be enough for the Fed to cut.